Hi, welcome back. In this session, I'd like to focus on the fourth and final way in which you can be a growth investor, and that is to be an activist growth investor. Now, when we talked about activist value investing, there you invest in a company, but in addition to being an investor, you took a role in how the company was run. That's the essence of activist growth investing as well. Rather than invest in a company after investors basically recognize it's a growth company and hope that investors come around to pricing the company more highly. With activist growth investing, you try to invest in growth companies before these companies are recognized as successful growth companies, and you hope to make money off that resultant price increase. In fact, if you look at what separates activist value investing from active growth investing, one of the key components is what stage in the life cycle you come in at. Activist value investors tend to come in when companies are mature, in decline, basically trying to fix these companies after the good times are over. Growth investing, or activist growth investing in its most typical form, is with young startups. So basically you're finding idea companies or young companies before they've taken off, often before they're public. You invest in these companies and you hope to make money once success hits, which might take the form of either going public or selling to a public company. There are some activist growth investors who do enter later in the process for companies that have growth opportunities which have been untapped, but that's much more unlikely. So I'm going to focus primarily on venture capital investing or some parts of private equity investing, because the two are kind of are overlapping in some areas in looking for young growth companies to invest in. So here's the core of venture capital investing. Venture capital investing, as we know it, can trace its lineage back to the 1950s, when the American Research and Development Fund, which is one of the first venture capitalists, provided seed money, startup money, for the founding of Digital Equipment, one of the first technology companies. So that's the first. So when you think about venture capital investing, those are the traditional venture capital investors. They've been around the longest. In the 1980s, you got a competitor coming in the form of leveraged buyout funds that while these funds usually targeted mature companies, sometimes if they had funds left over, they would take over publicly traded companies with growth potential and make them into private companies. And the third, and this is of more recent origin, you got private equity or PE funds that pool the wealth of individual investors, most of them individually wealthy, and they invest in private companies that show promise. Essentially, they're the ones competing head to head with venture capitalists for some of these young companies that are looking for capital. So essentially what the private equity funds bring, which the venture capitalists did not have, is the private equity funds tend to be more diversified than the pure venture capitalists. They're able to do things that a pure venture capitalist might not have been able to do, take on risks that they otherwise wouldn't have. So if you break the process down, this is how the process by which a young company gets venture capital money kicks in. The company gets started by a person who believes in the business, has a great idea, and at some point in time that person runs out of the capital to put that idea into practice. So that's when they go out and try to provoke investors to invest in them by offering their ideas out, by selling themselves. Once they get the interest of the venture capitalist then says, "Okay, I'm willing to invest in your company. Here's how much I'll invest, and here's the quid pro quo. Here's what percentage of the company I want back in return." And that's where you go head to head, because at that stage you get a conflict. The venture capitalist wants to attach a low number to the value so that he can get a much higher percentage of that value when he supplies capital. The owner of the business obviously wants a much higher value because he wants to give away less of the business for the venture capital. Depending on how desperate the owner is for the capital and how many venture capitalists are interested in the company, you're going to fall either towards the venture capital end, where the venture capital is going to get a much bigger stake of the company than he really deserves given the value, or the founder's end, which is a much more reasonable percentage of the value. So assuming the venture capitalist and the founder come to an agreement, you structure the deal where essentially the private equity investor, the venture capital, gets a percentage of the company for the capital he supplies, and usually there's a quid pro quo. That capital is negotiated, which is you decide you don't want the founder to take the capital and run out of the company. You want the money to go back into the business, which creates terminology that's fairly unique to venture capital called pre-money and post-money. The pre-money valuation of your company is the value that your company would have had without the venture capital cash coming in. The post-money valuation is with the venture capital cash. So at the minimum, the post-money value should be the pre-money value plus the cash. But it could be much larger because by bringing the money in, you might relax constraints that otherwise exist and allow the company to grow fast and do things it could not have done. Usually the venture capital investor will impose constraints on the founder, saying if you decide to go out and approach somebody, because you don't want the founder to go out and undercut your position by selling the business to other people. So when you have a venture capital deal, it's not just the percent of the value you negotiate for. You also negotiate for what constraints you're going to put on the founder when he or she goes out there and tries to get more capital. Now, once you become an equity investor in a company as a venture capitalist, then the post-deal process begins. And in many cases, venture capitalists, in addition to supplying capital, also supply their expertise, their management skills. So if you're a technology venture capitalist, you've done this before. So you might be able to tell the managers the right way to do things, or at least guide them along on the right paths. So often you're providing management input. You're providing management input to these companies. Assuming that you provide the right input and you pick the right companies, somewhere along the game, 3, 4, 5 years after you invested, you're looking for ways to get out of the investment and make money. And there are 3 ways you can get out of an investment. One is you can try to take the company public. That's often the most lucrative exit strategy. It's available only to a subset of small companies. But if you succeed and you can go public, then you might not immediately cash out, but at least you can start monetizing your investment in the company. The second alternative is to sell your company to a publicly traded company who's willing to pay a premium over what the capital invested in this company was, and you take your share of those spoils. The third and the least attractive option, if you can't go public and you can't sell the company, is to use it, if it continues to run and make cash flows, to use those cash flows to cover your investment. The reason it's often the least attractive is because you're then stuck with a company as a long-term investment, and you're not going to make the kind of big payoff that you did with a public offering or even with a sale to a public company. So that's the process of venture capital. Let's look at the biggest risk in investing in young companies. The biggest risk is most young companies don't make it. And you can see this in evidence that has actually been accumulated by the US government. The US government tracks how many companies get started in different businesses, and it maintains statistics by revisiting these businesses 1 year, 2 years, 3 years, 4 years, 5 years after they start to see how many still survive. So here's the way I'd read this graph. If you look across all firms, for every 100 firms that start, 81 survive year 1, only 65 survive year 2, and basically as you get out to 5, 6, 7 years, you see that only 30% make it. If you're a venture capitalist, you want your company to be one of the 30% that makes it, not one of the 15 or 19% that don't make it off year 1. Are venture capitalists aware of the survival risk? Absolutely. They know that most of the companies they invest in will not make it. So what do? They hike up the discount rate they will use for these companies, because here's how most venture capitalists value companies they invest in. They first project out the earnings that this company will have in some future year, let's say year 3 or year 5. They apply a multiple to those earnings based on what publicly traded companies trade at. So let's assume that you expect your company to have $10 million in earnings in 3 years from now, and that companies in the sector trade at 20 times earnings. 20 times 10 million is 200 million. So that's your estimated value in year 3. You use your target rate, which can be as high as 40, 50, or 60% for young startups, to discount that 200 million back to today. Okay? And the higher the discount rate, the less value you have today. So already you can see the game in process. Because the venture capitalist wants that value to be a small number, so you can get a much higher percentage of value, he's going to use conservative estimates of future earnings. He's going to try to use the lowest multiple he can, saying this company is riskier. And then he's going to try to use the highest discount rate, the highest target rate of return to discount it. Which means that when you look at a venture capitalist target rate of return, it's difficult to decipher how much of this is a really required rate of return and how much of this is game playing to get the value down. Whatever the reason, though, we know that the actual returns that venture capitalists and private equity investors make from investing in young companies is far lower than those target rates of return. You never see them make 60% across their young investments. And in fact, the target rates of return for venture capitalists might vary across different investments, from angel financing, where you're investing in a company which is just an idea, to later stage younger growth companies, but the actual returns in every one of these groups lags the target returns. In fact, if you look across time, and this is an interesting question to ask because it seems like venture capital should generate higher returns. It's riskier, and these guys do bring something to the table. And you look across long time periods, you do see a fairly surprising result. If you take the very last column, over 20 years, venture capitalists have generally done better than the S&P 500, especially if you look across the entire 20-year period. But if you look at the last 10 years, it's not been pretty. In fact, in the last 10 years, venture capitalists have either barely broken even, or in the case of earlier seed venture capital, they've actually underperformed the market. So that's over a decade. With all the risk they took on, they actually ended up with returns lower than the market. You're saying, how to reconcile the 10 and the 20 year? You go back 20 years, you're getting the 1990s, which is almost a dream period for venture capitalists cashing out. It might have been an exceptional decade. Across a very, very long term, venture capitalists do better than the S&P 500, but not by very much, maybe 3, 4, 5%. And that's without adjusting for the special risks they face as investors investing in young startup companies. So if you decide to go down this road of being an active growth investor, a venture capitalist, a private equity investor, here are some of the things I think you need to do to succeed. First, you need to pick your companies well. To me, the biggest skill a venture capitalist can have is picking the right companies. And often that means picking the right people, because these companies, there's really nothing to the company other than the person who's come to you with an idea. Knowing whom to trust and whom not to trust is a critical part of being a venture capitalist, which is part of the reason you'll often find young startups there are serial entrepreneurs, people who go from starting up one company to another, because having the track record of having done it in the past gives venture capitalists more faith that you can do it again. Second, diversify. The lessons about diversification are apply in spades if you're a venture capitalist or investing in young growth companies, because you got to spread your bets and you got to spread them far more widely, which is part of the reason I think the trend of private equity investors entering this market is interesting, because private equity investors have generally been more diversified than pure venture capitalists who tend to be sector focused. You tend to be the technology VC or the social media VC. Private equity investors, by spreading their bets across young startups in different businesses in different countries, I think start off at a significant advantage in this process. Third, you're not just an investor. You've got to provide management advice. You need to understand the business you're investing in and help the founders of these companies, often are not managers and business people, to convert their ideas into commercial success. Fourth, protect your investment. As the company succeeds and grows, it's going to go out and raise more capital. Make sure that the pieces are in place to protect your investment, that you don't get pushed to the back of the line by the new venture capitalists and the new investors who come in. And know when to get out. Having a good exit strategy, knowing when to get out, is critical to making money off VC or private equity investing. Overall, in this session, we've looked at active growth investing. Essentially, it's the process of investing in young growth companies, often when they're private businesses, and nurturing them until they go public or get sold to a public company, hoping to make money of that payoff that comes from taking them public. So if you can pick the right companies and you can nurture them well, this could be a lucrative strategy. Though historically, it's not been as lucrative as we think it is. Thank you very much for listening.